We're at a really interesting point in the stock market here in the end of 2020 and moving into 2021. Some people are arguing that there's going to be a big market crash like we had in March of 2020 again. Others are arguing that this is looking a lot like 1999, and in the beginning of 2000 the Nasdaq was at an all-time high but then broke out again and doubled from its all-time high. Those two scenarios are extremely different, and we could be in either of those or somewhere in between. So let's talk about it. As a disclosure here, none of the information in this video is investment advice. I'm totally unsure of which direction the market is going to go in the beginning of 21, the later parts of 2021. I'm a financial advisor, licensed investment advisor, CFA charter holder, CFP professional. All of those things do not certify me to know exactly what the market's going to do. My crystal ball is as bad as anyone else's. I have a couple personal theories. I'm just going to share some of the prevailing ideas out there right now. The overarching economic backdrop here is that we're in the middle of a second wave of COVID cases. The global pandemic is spreading. There are more and more lockdowns, at least here in the United States. Certainly in countries around the world, there are continued lockdowns. You know, the market dropped 33%. S&P 500 dropped 33% this year in March when that all started happening. But our government really stimulated the economy and kind of bailed us out of that. And a similar thing could be happening here now. The House just passed the second stimulus package. First one was in April of 2020. Now we're here in December of 2020. That is going to give some checks, smaller checks, but still checks to all individuals and some for each children in the United States. It provides funding for small businesses, schools and hospitals, things like that. So it is another pretty meaningful stimulus. Additionally, and in my opinion more importantly, the Federal Reserve has committed to continue to provide stimulus to our economy in almost an unlimited quantity. I think they used that term directly. And in my opinion, again, that's exactly what helped us the most out of the hole that we were in March and through April and May when the stock market, S&P 500 in the United States, was rebounding. It was largely because of all the stimulating activity that the Federal Reserve, chaired by Jerome Powell, pushed forward and through our economy. Again, COVID's getting worse, but our backdrop is supported. I think you can make the argument there that we're going to be able to kind of support through the loss of small business. Now, not every industry will be able to. Hotels, airlines, all the hospitality stuff, especially small businesses in those categories, are going to get really beat up. I think many of those will never come back again in our future like we once knew them in the past. So it's a sad scenario for certain sectors. But I think most of the economy will be able to move on through that. What that means for the stock market is it could have a quick, big recession. It could have a regular non-recessionary 15, 19% dip, or it could kind of just ignore it altogether because the Federal Reserve has said that they will support us completely. It's really anyone's guess. Keep in mind that during a regular calendar year, when our economy doesn't have these major, never-seen-before effects going on within it, the stock market will see 10 to 15% dips, and those are usually considered like healthy corrections, I think is the term that the financial media likes to use. But it's pretty typical to see 10% dips, and we almost got that in 2020. Of course, the one in March, 33% down. And then in July, I think we were about 8. I could be wrong. Maybe it was a 10% dip. So a base case would just be that in the first half of 2021, we'd see a regular 10% market dip. That wouldn't be anything unlike a regular calendar year that doesn't have a global pandemic. What is potentially a more interesting scenario is if we could duplicate what the Nasdaq did in 2020. As of the recording of this video, we're at an all-time market high or within a couple points of it. And we were at a really similar point in 1999, and market pundits were saying, hey, this thing doesn't have any more legs. We're at an all-time high. This thing has to come back down. A really important thing happened from a technical perspective, though, which I think was a big reason why the trading that existed in the market in 2000 was able to push it 50% higher. If you look at the technical trading range from the market in 1990 to 1999, it followed this kind of 10-year trend. Well, then the market stayed above that trend. What it was a 10-year trend, it popped above it and stayed above it for over 200 days, which means that the 200-day average also got above that trend. Shortly after the market had been above it for over 200 days and the big moving averages were above it, 50, 200-day average, that's when I think it really had technical support to be able to just shoot right through the roof. And that's what many traders, I think big institutional traders are watching these things when they had the buying activity that they had to support that kind of market growth that the Nasdaq saw in 2000. I'm not saying this exact scenario is repeating itself, but so far it has some similarities. We've followed this 10-year trend since the bottom of like 2009. The market's traded within it. In the last 3 months, the NASDAQ has jumped above that trend and stayed above that trend. It's come down to the top of that trend line a couple times and supported it. The argument that some people are making has some validity to say that if we were able to stay above that long-term trend for long enough that the 50-day average and 200-day average got above it as well, that would show the major institutional traders, pension funds, endowments, whatever, that make up a lot of the market volume, and some of the high-frequency trading, which makes up a lot of the market volume, that this thing could still have legs and you could get a big blow off like we had in 2000 before a huge subsequent crash. I think the big counterpoint here to this technical argument is an economic one, which is,
well, hey, in 2000 we had this dot-com bubble. People were going, hey, the internet's going to change everything. And there's no rhetoric out there like that right now.
I think 5G could be a similar argument. 5G and vaccines. Vaccines is as big of a story as the dot-com bubble was in 99. If it remains a big enough story for the next 3 to 6 months throughout 2021, or if 5G, the implementation of it, becomes a big enough story throughout 2021, people could lean on those headlines and kind of start to, from an economic standpoint, rationalize some of these all-time high valuations and what I'm saying could be continued further high valuations. The big point here, though, is that in that scenario, the market going up another 50%, that would be wildly different than the market crashing 40% down. And I think both of those options are on the table for 2021, which is going to be nuts to see exactly how it pans out. Please do not take this as advice. I'm telling you, I don't know which way this is going to go. But if I was an investment professional looking at this scenario, which I am, or if I was an individual just investing my own money, I would recognize that both options are on the table and I would not put all my eggs in one basket. I certainly wouldn't be shorting the market because if that 2000 scenario happened in 2020, 2021, you'd lose a ton of money. I certainly wouldn't be going all in, especially not into any one specific asset class like large cap growth right now. I personally have a little bit more money in small cap value. That's not an endorsement of small cap value to anyone else. It's just where I feel comfortable holding dollars at right now. So you need to be diversified in a market like I think 2021 could be, where maybe we get a little bit of both of these scenarios that I just talked about. If you're watching other content like this video, be very cautious of opinions that people have when they seem very certain about one outcome over another. Certainty can really fuel ego. And once someone thinks they're certain of something and they build their ego up because of that thing, they are definitely going to be biased towards it, and they're not going to be able to accurately consider other options that could potentially happen once they're so influenced towards one outcome versus another. So if anyone says something is a sure thing or they're certain of a particular outcome happening, be very cautious of that. You definitely want to understand where they're coming from with their thinking. You want to look at all the facts that are informing their opinion so that you can figure out if there are any holes in those facts and if there are other ways that they're not considering this certain scenario. I'm telling you, I wouldn't put almost any faith in anyone who's relatively confident of it going one way or the other. I follow a lot of financial, not media personalities on Twitter, but financial talking heads that have developed a good following of their own because they're really good independent thinkers, and I respect them very well. I follow certain ones in the category that say we're going to have a huge stock market crash in 2021, and I follow others who are saying that from a technical perspective, this could be a huge blowout and you're going to want all your money invested very aggressively in 2021. There are people in both camps that I respect very well and I would consider to be a very smart individual. So that just goes to show you how difficult of a decision-making time this is going to be, which is why I'm taking the really easy way out, and I'm not staking my claim in any either camp. I'm saying it could be a little bit of both. It might be somewhere in the middle, but as an investor, I'm just going to stay diversified. Feel free, let me know in the comments down below how all of you are investing your money. I'm kind of curious to see more and more third-party opinions. I mean, I work with hundreds of clients and I see their investments, but most of those are based on my recommendations or my firm's recommendations. So I'd like to get a really cool database of individuals out there who are managing their own money to see what they're kind of doing for 2021. If you leave some comments down below with that information, it could help me out in putting it together. I heard a very educated finance professional talking about how 2021 is going to bring a regime change, and regime changes can cause a shock to economies, which will cause the stock market to collapse. That to me sounded like a political opinion. He's talking about how Trump's out of the office and Biden's going to be into the office. I wouldn't tell you I think either one of those guys is going to be much more beneficial for the market than the other. I'm of the opinion that you should keep politics out of your portfolio. But there's the argument being made that because of this regime shift, some non-stimulative bills would be passed in the economy, and that very well could be, that are going to have enough of a negative impact to bring the stock market values down. I don't know if I'm sold on that completely. I think people who are really biased towards one political party are always going to argue that when the other party's in power, that party's going to bring the market down. So Making a political argument from this, I think, is almost impossible to be completely unbiased and look at all the facts objectively, unless you really were totally politically agnostic, which is almost impossible for any individual person to be. So you have the economy, you have politics, you have technicals, which I talked about. A lot of different things are going to impact the market in 2021. I'm just kind of along for the ride. I'm going to watch to see what it does. Hopefully it goes up. I have money invested, so hopefully values are higher 1 year from today or 2-3 years from today than they are now. But we're just going to have to see what happens between now and then. Most of the viewers on this channel are not of retirement age. We are in 20s, 30s, and 40s. So we have time on our side, meaning if you have all your money invested and the market goes down 40%, it's really not that big of a deal, especially if you don't sell, because in some undetermined period of time, it's very likely that investment value will come back unless we turned into like Japan in the 2000s, which would be a really bad scenario. I don't think that scenario is likely, but I'm not positive of it. My point is just that when you have time on your side, you really don't have to put too much implementation of your worry into your investment accounts, because you could just sit on whatever you're most comfortable sitting on and let compounding interest over time help out your growth. That's what I'm going to do with a chunk of my money. If you have any other random questions, as always, please leave them in the comments down below. I'm happy to reply to all the comments. I always do. I see everything there. And if you got to the end of this video, I really appreciate the support you're giving to the channel. Watching the whole video helps me out. Liking this, subscribing to the channel, all those things are great and I appreciate them. And as always, thanks for watching.